Welcome, everyone, and thank you for joining me today for this special presentation on the key financial data points for 2022. We're going to cover the tax rates, thresholds, limitations, exemptions, and much more for this year. Please do keep in mind that until Congress adjourns for the year, these numbers are still considered preliminary. I'll update you if anything changes after this presentation. My name is Tony Lajeunesse, the CEO and president of TL Financial Group. Today's webinar is going to bring you up to speed regarding some updates and changes to the key financial data points for 2022. We're going to cover a lot of important information over the next 30 minutes. So as always, if you have any questions for me, please do not hesitate to reach out. Our team is here to help you. All right, let's go ahead and get started. 4 years ago, the Republican-led Congress approved the most far-reaching tax legislation since 1986. It's called the Tax Cuts and Jobs Act, also known as TCJA, and it was passed without consensus and managed to turn 100 years of tax law on its head. Not to be outdone, 1 year ago, the Congress passed the Secure Act, drastically changing the rules around the inheritance of retirement accounts by non-spousal beneficiaries. The ink was barely dry on the Secure Act when COVID-19 pandemic became an international tragedy, sparking a variety of stimulus measures passed in 2020 to address the economic challenges it has wrought. And so where are we now? The Biden administration has put forth the Build Back Better bill, which passed the House on November 19th, but then the Senate rejected the bill. However, it could be resurrected sometime in 2022. Many of the proposed tax changes we thought were coming are not in this bill. So we will not see an increase in the top marginal tax rate or the capital gains rate. There's no change in the estate tax exemption and no billionaires tax. So what exactly was in the bill? Roth conversions of after-tax funds and retirement accounts would be prohibited for all taxpayers starting January 1st of 2022. Also, it would prohibit all Roth conversions for taxpayers in the highest ordinary income tax bracket, starting on January 1st, 2032, and it would have imposed required minimum distributions on large retirement account balances if the taxable income is greater than $450,000 for married filing joint, or $400,000 for single, and the combined value of an IRA and defined contribution plans are greater than $10 million. Also, traditional and Roth IRA contributions would also be prohibited for these groups of people as well. And that would go into effect in 2029. There would also be a cap on SALT, which stands for state and local tax of $72,500. There would have been a 5% surtax on modified adjusted gross income in excess of $10 million. Not many of us have that problem, although that would be a good problem to have. Also, there's no additional 3% surtax on modified adjusted gross income greater than 25 million. And lastly, S corporations would be considered investment income. So it's unsure if this bill will come back and what it might look like if it does, but these are things to keep in mind, and these are the things that we're watching for. But let's get into what the IRS has told us for 2022. The big news is that the tax brackets and tax rates are for 2022. There's still going to be 7 tax brackets in 22, along with a 0% tax rate. But let's run through them. Here are the tax brackets and rates for single filers in 2022. The lowest tax bracket you can see goes up to $10,275. Single filers with taxable income over $539,000 are in the top 37% tax rate. Here are the tax brackets and rates for those married filing joint and surviving spouses in 22. The lowest tax bracket you can see goes up to $20,000 or up $20,550. Filers with taxable income over $647,850. Those people are in the top 37% tax rate. Here are the tax brackets and rates for those filing as head of household. The lowest tax bracket you can see goes up $14,650. Filers with a taxable income over $539,900 are in the top 37% tax rate. And here you see tax brackets and rates for those married filing separately. The lowest tax bracket you can see goes up $10,275. Filers with a taxable income over $323,925. Those people are in the 37% tax rate. For most married couples, it is usually more favorable to file a joint tax return, but there are some circumstances where it really does make sense to file separately. And this is something I can discuss with you in a meeting if it applies to you. And lastly, here are the rates for estates and trusts this year. You can see here that the top 37% marginal tax rate is kicking in for estates and trusts over just $13,450. So let's talk about the standard deduction for this year. The standard deduction shown here increases slightly from $25,100 in 2020 to $25,900 in 22. For married filing jointly filers, it goes from $12,550 to $12,950 for single and married filing separate filers, and from $18,800 to $19,400 for head of household filers. Now remember that the ability to take personal exemptions has been eliminated, a change which some degree tempers the benefit of the higher standard deduction. The additional standard deduction amounts went up slightly from 2021. Thus, people who are blind or over the age of 65 receive an extra deduction of $1,400 each in 2022, up from $1,350 in 2020. The additional deduction also increases from $1,700 in 2021 to $1,750 in 22 for taxpayers who are blind or over 65, as well as unmarried and not a surviving spouse. For 2022, the child tax credit is $2,000 per child. $1,500 is refundable for those with income under $400,000 filing joint, and $200,000 for all others. All right, let's review capital gains and qualified dividends for 22. Tax rates on long-term capital gains and qualified dividends generally are unchanged. They're at 0%, 15%, and 20%, but the brackets for all the rates will change. For 22, the 15% rate applies to capital gains or dividends that push taxable income above $83,350 for joint returns and surviving spouses, and then $55,800 for heads of households, also $41,675 for single and married filing separately taxpayers, and then $2,800 for estates and trusts. The 20% rate applies to long-term capital gains or qualified dividends that propel taxable income past $517,200 for joint filers and surviving spouses, $488,500 for heads of household, $459,750 for single filers, and $258,600 for married filing separately filers, and then $13,700 for estates and trusts. Remember that exceptions also apply for art, collectibles, and Section 1250 gains that are related to depreciation. Now we'll cover some additional taxes that may be relevant to you. The alternative minimum tax has been adjusted for inflation and will continue to affect fewer and fewer taxpayers under the TCJA. In 22, the exemption amounts rise to $118,100 from married filing joint taxpayers. And then you can see here up from $114,600 in 21, $75,900 for single filers, up from $73,600 in 21, $59,050 for filers who are married filing separately, up from $57,300 in 21, and the exemption amount for estates and trusts rise to $26,500 from $25,700 in 21. Now, some high income taxpayers owe the net investment income tax, also known as the NIIT, And that tax is 3.8%, which is levied on the lesser of net investment income or modified adjusted gross income of over $200,000 for single or $250,000 for married filing jointly. These amounts remain unchanged for 21. Net investment income includes taxable interest, ordinary dividends, capital gains, and other income categories, and some expenses can be subtracted. Now, what about gifting rates and estate tax this year? Let's see what that looks like. Estate, gift, and GST, which is generation skipping tax, those exclusions rise from $11,700,000 in 21 to $12,060,000 in 22. The top federal estate tax rate remains at 40%. The IRS has issued final regulations that there will be no clawback at sunset. The value of gifts one person can give another without reporting it on a gift tax return remains $15,000 for 22, and unlimited payments for tuition and medical expenses are permitted. So let's talk about education credits, deductions, and distributions. Just as in 21, in 2022, taxpayers with qualified education expenses can reduce their tax bill by up to $2,500, of which $1,000 is refundable, thanks to the AOTC, if their modified adjusted gross income doesn't exceed $80,000 or $160,000 for married filing jointly. At that income level, the credit starts to phase out. So this non-refundable credit is worth up to $2,000. In 2022, the credit starts to phase out for taxpayers with modified adjusted gross income of $80,000 or $160,000 for those who are filing jointly. The lifetime learning credit offers two main advantages over the American Opportunity Tax Credit. The LLC can be claimed for an unlimited number of tax years. The AOTC is limited to 4 tax years per eligible student, and the student doesn't need to be pursuing a degree. So the AOTC requires the student to be pursuing a degree or some other type of credential. Parents and others who want to save for a student's education costs can contribute the maximum of $2,000 to these accounts. Contributions are after tax, just like a Roth IRA. And then when you withdraw the contributions and the investment earnings, they come out tax-free if the funds are used to pay for qualified education expenses. So the maximum contribution stays the same in 2022 as in 21. And then it starts to phase out for taxpayers with modified adjusted gross income of $95,000 or $190,000 for those who are married and filing joint. For 529 plans, as in 2021, the law continues to allow up to $10,000 a year in 529 plan distributions to pay for qualified private school, which is kindergarten through 12th grade education costs, but this excludes homeschooling. It also has a provision which might encourage taxpayers to focus on 529 plans rather than Coverdell's. So previously, for a 529 distribution to be qualified, it had to be used for higher education costs, like in college or technical school, whereas K through 12 expenses have now been qualified as an expense for Coverdell plans. The law also allows rollovers from 529 plans to ABLE accounts for disabled beneficiaries until December 31st, 2025. But make sure to check with the specific state because some states are decoupling from the federal and not treating the 529 plan withdrawal for K through 12 expenses as a qualified distribution. They'll also have specific rules in connection with an ABLE account rollover as well. So what's new with retirement plans? They continue to remain in the news and are subject of much debate. The total amount that employers and employees combined can contribute to a 401k or similar defined contribution plan rises to $61,000 in 22, and that's up from $58,000 in 21. The limit on how much compensation can be counted under a qualified plan rose to $305,000 from $290,000. Meanwhile, the basic annual benefit limit for defined benefit increased to $245,000. As a reminder, RMDs, which are required minimum distributions do not start until age 72. In 2022, as in 21, taxpayers who save for retirement in a traditional or a Roth IRA are limited to a $6,000 contribution plus a $1,000 catch-up for those 50 and older. However, there is no age limit on your ability to contribute to an IRA as long as you have earned income. Taxpayers who aren't participating in a retirement plan at work generally can fully deduct their contributions to a traditional IRA. However, income thresholds limit the deductibility of such contributions for taxpayers who are participating in a workplace plan or if their spouse participates. You can see that in the table on this slide. Please remember that all this data is available to you on a simple 2-page cheat sheet on our website. All right, let's cover some major health related numbers for 22. We'll discuss HSAs, long-term care premiums, and Medicare numbers for the year, and then we'll wrap things up. All right, health savings accounts offer the rare tax trifecta. Contributions are made pre-tax. They enjoy tax-free investment returns, and money comes out tax-free if used for qualified medical expenses. The downside is that such accounts currently are available only to those who are enrolled in a high deductible healthcare plan, which can pose steep upfront costs to you. In 22, the minimum annual deductibility for a qualifying health plan is $1,400 for an individual plan and $2,800 for a family plan. The maximum deductible contribution to an HSA in 22 is $3,650 for individuals. For family coverage, the maximum deductible contribution is $7,300, and there is a $1,000 catch-up contribution available for ages 55 and older. Taxpayers who are paying for long-term care generally can deduct a portion of their premiums as qualified medical expenses. The deductible varies based on the taxpayer's age and is subject to the 10% floor for medical expenses. As in previous years, the 22 income brackets used to determine Medicare premium surcharges for high income retirees will be indexed for inflation. So as a result, some retirees may experience a reduction in their Medicare surcharge costs next year. The standard premium amount in 22 is $170.10, though some Part B beneficiaries pay less due to the hold harmless provision that protects them if Social Security benefits rise slower than Medicare premiums. So the people who pay the higher figure include those signing up for Medicare Part B for the first time, those who don't receive Social Security benefits, and those who don't have their Part B benefits automatically deducted from their Social Security benefits, and others. Meanwhile, some higher income beneficiaries will pay more than the standard premium as shown here. Remember that Medicare premiums apply to income from 2 years prior, and that decisions made today will have future impact. So if you're cashing in some government bonds or looking to do a Roth conversion this year, please consult with us before you do that, because we can help provide some guidance with regards to that. Also too, if your required minimum distributions begin this year and they are a significant amount that also can impact your Medicare Part B premiums, please consult with us on that as well, and we'll let you know what you can anticipate from your personal situation. And for our last topic, there are key Social Security figures that pre-retirees and retirees really should be aware of. The Social Security estimated maximum monthly benefit is $3,345.22, up slightly from $3,148.21. Now, the maximum taxable wage base in 22 is $147,000, up from $142,800, and the tax rate remains the same. It's 6.2% each for the employer and employee, so it's 12.4% if you're self-employed. Now, the so-called full or normal retirement age for claiming unreduced Social Security benefits is 66 for people who were born from 1943 through 1954. For those born after 1954 but before 1960, full retirement age is going to be 66 plus some numbers of months depending on the birth year. But for those born in 1960 or later, the full retirement age is 67. Sometimes retirees are surprised to find their Social Security benefits are being taxed. This slideshow shows the income thresholds at which benefits start to be taxed. So to figure their bill, beneficiaries must compute their provisional income, which is also known as their combined income. So combined income equals income plus non-taxable interest plus half of your Social Security benefits. We can actually calculate this for you to see if you're going to be taxed on your Social Security. Our tax code has evolved from a 2-page form in 1913 to over 75,000 pages of complex rules that are constantly changing. So we covered a lot today. This reference card can help you keep track of the key numbers that will impact your financial life. This presentation may have brought up questions on your tax situation that you'd like to have more clarity on. If so, let's schedule some time to meet so we can discuss planning and strategies for your particular situation. We can do that soon or just throughout the rest of the year as you come in for your financial reviews. This is stuff that we really need to pay attention to. So thanks so much for your time. Remember, I'm always available to meet with you on these topics that we discussed here today. And I'm happy to share a copy of the Key Financial Data Card with any friends or family that could find it useful. Just let us know and we'll be happy to send it out. Thanks again, and we'll see you soon.